Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. I dive deeper into all these topics, looking for potential investment opportunities, showing you how my approach is to the markets and my strategies. And you can use those approaches and strategies to better your entry points and exit points if you like. We do have a discount code. It's called discount, but the discount wasn't as big as it was before. So it's $5 off on a monthly membership, and it's $50 off on a yearly membership. And every once in a while, I will run specials that will bring that down periodically. So stay tuned and listen into each episode to see when those cycle, I'll just call it when I cycle those specials in there, and they'll only last for a period of time throughout special times like Christmas and whatever else. So start with me. It says last oil bull market compared to this bull market, looking at the comparisons and the long term to look at here. So crude oil, and I'm interested in crude oil. Crude oil is incredibly cheap right now on a ratio perspective. We are at around 40, a ratio against gold. So 1 ounce of gold, 40 barrels of oil. That is the second cheapest time it's been in history, all the way back to the since we started using oil in the 1800s. So last bull market, we started in 98, 99. That's the commodity to stock ratio bottom. We broke out of this downtrend, which isn't a huge downtrend, but it's got 1.2 points there. This was your consolidation. It even goes back before, but second hump, third hump was here. And then we broke out, retested, and we're working our way on up. And it went all the way to 140. The bottom was almost $10 a barrel. Now, here's the thing. If you bought it at 10, or even if you bought the breakout and the retest at $18, and you said oil was going to go to $140 a barrel, you would be called nuts, crazy. That is just unbelievably high. There's no way oil could get there. How could people afford oil at $140 a barrel? No one could figure it out. But that's what happened. This is the ratio I'm talking about, commodities to equity ratio, just to show you guys that the buy points were 1970, 1998, 99 when this was turning. And we are way down in no man's land. And that was 2020 was the bottom here, question mark. And are we going to come all the way back up? I am betting that that's probably a good bet. Each time these have rose, this rose, expansionary phase of real estate, 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 and we are in an expansionary phase of real estate. No way. Now, there are other things that could be driving inflation in the system that are different today than these periods before. So that's the main driver historically. But there could be other drivers in the future that are more fiscal driven. If you go into debt levels and interest payments and money creation and QE and all that garbage to try to keep the whole system in check. The current setup, where the commodity to stock ratio bottomed in 2020 and where I purchased, which was in this section over here after this complete bottom, it was over here. I rode it all the way up, and here we are doing the retest. Does that look familiar? We've got a 3-hump consolidation, a breakout, and now we are doing the retest. Now, could we pull back down to $60 or something? Very well could. That is still game to do a false breakdown and then the slingshot higher. I'm not stating that we're going to go straight higher. What I'm stating is the approach is similar. So this breakout retest to this line, and I did this on logarithmic. This isn't on logarithmic here, I don't think, is the same as this guy here, the breakout and then the retest. So we could pull back a little bit more, get the full retest before heading higher. And this is the long-term view, tying it all together. Bull market, peak oil in the United States, conventional oil, was here. Peak conventional oil in the world was here. Peak conventional and non-conventional oil could be here. And then I don't know what turns it down. Like I don't know. Maybe we go off oil. I doubt it. We'll see. But we could do a retest here a little bit lower. Totally possible. But look at the overall setup. The consolidation, the breakout, the consolidation, the breakout, the consolidation, the breakout, and then the retest, the retest. This one didn't do a retest here. It's all eerily similar when looking backwards. Nostra House of Gold says CIA asset. Michael Saylor wants the U.S. to sell all of its gold and buy Bitcoin. These are the talking points he's been given by his handlers. The U.S. doesn't have any gold. It was sold a long time ago. Now they have a great excuse for why Fort Knox is empty. Sell it all and put it into Bitcoin. Because a digital asset is the best thing that you just gotta own Bitcoin, right? The thing that gets me weird is I don't go around forcing people or trying to sell everyone on oil. I like oil. I think oil has incredible value to humans. We've created the world and society that we know today based off of fossil fuels, and more in particular, oil. And it's used in everything out there: paints, chemicals, lubricants. It's basically in like 90% of the products that people use in everything. Building homes, the tires in rubber, plastic bumpers on cars, the paint on the car, the whole interior on the car. It's in all sorts of stuff in terms of stuff that I don't even want to get into. It's in a whole bunch of things. So that's where I put my money. It's used the most. It's the number one commodity. But yeah, we need Bitcoin for I don't know what. So time over money. Time is the only currency you spend without knowing your balance. Use it wisely. It's also the thing that you can't accumulate more of. You can always make more currency, but you can't make more time. And I don't know if it's possible that artificial intelligence or humans or whoever figures out a way to reverse aging in cells. I don't know, but there's a cool movie. I think it was called In Time. Justin Timberlake was in it, and that other, I don't know whoever else was in it, but that's kind of a cool movie. It's from the um, Goring and Rosenzweig write up, and I haven't read the whole thing yet. I'm reading this, and I want to read it to everybody. So this is called the depletion paradox. The great drama of American shale production may now be nearing its final act. For years, we've anticipated that the relentless growth in shale output would crest by late 24, early 25, catching many off guard. In hindsight, even this expectation might have erred on the side of caution. Quietly and without much fanfare, both shale oil and shale gas appear to have passed their zenith several months ago. Recent data from the Energy Information Agency reveals that shale crude oil production reached its high water mark in November of 2023, only to slide 2%, roughly 200,000 barrels per day since then. Likewise, shale dry gas production peaked that same month and has slipped by 1% or 1 billion cubic feet per day. The trajectory from here, according to our models, looks steeper still. Our view has been met with no shortage of skepticism. Many of our conversations with clients and industry insiders suggest a broad belief that today's declines are but a pause, not a prelude to sustained contraction. Optimists contend that higher prices and a deregulatory push will spark a new wave of drilling and fresh production gains. After all, President-elect Trump's Three Arrows energy plan promises nearly a 3 million barrel per day increase in U.S. oil equivalent production. But we see this optimism as misplaced. The primary forces behind the current downturn are neither policy related nor purely economic. They are geological and inexorable. Depletion, not market dynamics or regulatory overreach, is the central culprit. Admittingly, the incoming administration features several well informed and capable figures in the energy sphere, including Chris Wright and Scott Bessent. Their leadership will undoubtedly foster a favorable climate for drilling activity. Yet, even with their expertise and the administration's likely zeal for energy development, we remain convinced that these efforts will struggle to offset the entrenched declines now gripping the shale sector. The geology of the shale patch has spoken, and its verdict seems increasingly final. So, what they're basically coming to is that we have peaked in production of oil and natural gas in America in shale. And that occurred in November of 2023 of last year. Is that going to be the case? I don't know for sure, guys. Would I make investment decisions based solely off this? Maybe not solely, but I would take notice to this, and I would be watching the data. I would be watching it like a hawk. Because, if this is the case, oil is going to go to the moon. I mean, if we did in fact peak, that would also mean that our growth is gone because 95% of the growth came from shale. So growth is gone, and now we're just going to eat through spare capacity. Spare capacity is estimated at about 4 million barrels on 104 million barrel demand, about 3-4%. If we eat through that and Saudi doesn't have the capacity, I don't know, guys. We've never had a situation like that. You're going to see oil just roll higher, and we're going to have to destroy demand. Now, if that is the case, you're going to have problems with currencies and bond markets. So this is, I don't know. This is going to be crazy because we haven't seen anything like this. So the safe spots are obviously precious metals, and then you're going to see oil be the driver of a lot of stuff. Some people say that silver is the most undervalued commodity. Knowing this information, and if we are at a peak, I would say oil is the most undervalued commodity in terms of how much work we can get out of a barrel of oil and how undervalued it is compared to the work that it would take to do it with something else. That is how I would say it. But silver is also way up there because it will protect you against potentially a problem with the currency. It also is a part of the solution in renewables and electric crap that we have to make. Doesn't add up here. The labor market data is, quote, strong, and all metrics of core inflation in the US are rising. Yet, the Fed is set for their third rate cut for 2024 after saying they are not in a hurry to cut rates. Could Fed rate hikes return in 2025? Question mark. And this is obviously he's got a thread. So core inflation, I'm not going to go into all the details here, but for the most part, could the Fed do rate hikes in 2025? I think it's going to come if oil goes up. We'll see. Silverbank, it says, we'll have all Bitcoin worth $100 trillion and our adversaries will have all the gold worth literal hyperinflation. What an amazing, retarded time to be alive. It says, dump your gold, sell all the US gold, and buy Bitcoin. Then trade it, then trade is free. You will demonetize the entire gold asset class. and our enemies hold gold in their banks. So their assets would go to zero. Our assets would go to $100 trillion, says Michael Saylor. That is completely stupid. I mean, all you have to do if you're in a different part of the country or part of the world is just say, I don't accept crypto. All I accept is gold. So I don't know why us going to crypto would all of a sudden make everything crypto centric. All the value and all the wealth is not in crypto. It's in the physical assets that people want and want to buy and use in the world, and food and all that stuff. It's not in a digital asset that I can't even like make ends of this anymore. It just doesn't make sense. Cuppy, I feel like the only way to end this stupidity and finally put a top in the shitcoin market is for me to come out with Cuppy coin. Thoughts? Question. Let's do a Cuppy coin. Let's run it up to 1 million. 1 million each, because you know what? That's where the value is. Let's just start making up coins left and right, and that's where all the value is. This is more stupid than tulips. It really is. It's so dumb. And then this is what their response will be. Since I have a different viewpoint than other people, they're going to say, oh, he missed out. It's because he missed out. Missed out. It has nothing to do with missing anything. It just, I'm an outsider looking at this, just going, what the heck is going on here? And this is the Haktua coin, where they created this coin. People actually bought it, and then they just offloaded all their coins and made a bunch of money. Weird. So here's peak oil barrel. This was also in the oilbarrel.com. It says the findings. Lea County oil production is following the rig count graph and may have peaked. Eddy County oil production initially peaked in February of 2024, but has now started a new increasing phase as it follows the uptrend in the rig count, and it has exceeded its previous February peak. Midland County peaked in July of 2023, and Martin County has entered its declining phase. 3 of the 4 largest Permian oil-producing counties have now entered their declining phase. It will take a few more months to confirm this forecast. So that's Permian. And that's coming up, and this is Permian model here, and the Permian data that's following the model, and the potential peak here of the Permian scenario, 147,000 total wells from peakoilbarrel.com. Jorge says total shale oil and gas production likely peaked late last year. Both are already down 1%, and our models predict year-over-year production declines will turn sharply negative within 6 months. Today, 60 to 70% of all shale production comes from wells less than 3 years old. And here is what it looks like coming up, and you can see the decline rates are getting steeper and steeper. So as we run, the decline is going to get steeper, 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 steeper until we can't overcome those decline rates. And the majority of this oil here, if you look at the production, it's all coming from these, 3 or 4 that we've most recently produced. Most everything down here is going asymptotically to zero. Josh Young says a radical change in production is unlikely because the vast majority, if not everybody, is focused on the economics of what they're doing. We're not going to see anybody in drill baby drill mode, says Exxon upstream executive at the EIF. Okay, I showed that one. Mac10 says this is the lowest 2-week SPI volume in 20 years. The event is called sell, and then the artificial intelligence machines will melt down. But here's the volumes coming down, 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 down. And here we go up, 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 up. Volume declining as price goes up is a disconnect. Generally means that we are running out of steam. Brady on the silver chart, and I like updating this just because it's a yearly chart. The weekend is for stepping back and looking at the very big picture. Here's why silver is churning right here. It is trying to break out. The big breakout level using the yearly time frame is $31 to $32 an ounce. One of the most significant breakouts in history is in the making for silver. Again, the mother of all very probable cup and handles, the bigger the base, the higher in space. Fractal, smaller cup, and we are trying to break out right where we're at. The measured move target is 800% times 31 or $250 an ounce is what we've got here. And then we've got US stock market has never been so concentrated. We see this at market tops. The biggest US stock market cap is 750 times larger than the 75th percentile stock, the most ever. This metric exceeded all other past market bubbles. For example, in the 2000 dot-com bubble, the ratio did not surpass 600x. So here we are way up here, Great Depression, and we are exceeding everything. Bubble, bubble, bubble. This is retail investors cannot care less about the new bull market in gold. Portfolio allocation still hovering around the lows here. And this is a lead-in double bottom, and I think we could probably come out of here. It was up around 8% in 2011, but now we're down to 1% for implied allocations. The implied allocations for gold miners is down too, as we've come all the way down here. Here's Chevron. So Chevron reduces CapEx spending, Permian focus pivot to free cash flow maximization. The reality is more asset management going forward. Need to reduce long-term decline and maximize net present value. That's coming straight from Chevron on their Q3 conference calls. It says Permian Basin spend is lower than the 2024 budget and anticipated to be between 4.5 and 5 billion as production growth is reduced in favor of free cash flow. So that's what they're coming right out of their mouth. This could explain a lot about the November elections. The gap between economists' measurements of economic well-being and what consumers actually said they were feeling puzzled many researchers. Because the Fed and researchers measured the cost of living wrong. Still do. They lowered inflation in 1983 by changing the way that they measured inflation. The red line below measures home prices more like they did before 1983. They included the mortgage interest rate as part of the cost of housing. The cost of housing is the monthly mortgage payment, not just the cost of rent. So the estimates of the cost of living look something like this for the alternative versus the official, which is in the blue. So people are feeling a much larger increase in costs than before. Now, not everyone is feeling this because the ultimate measure that includes home and vehicle purchases shows that in 22 and 23, the cost of living outpaced the consumer price index, which I'm sure it did. Now, someone like me, I have a fixed rate mortgage. I don't have any car payments. I don't buy new cars. My cost of living is not, it doesn't take this into, I'm not a part of this. I've done everything I could to avoid that increase in my cost of living. I didn't want to rent because rent has gone way up. Rent is horrible. I hate rent, guys. People would tell me, "Oh, it's so much cheaper to rent." If I was renting, my rent would be 3 times my mortgage right now. 3 times. And I have it locked in. I can't imagine what it's going to be like 5 or 10 years out. My rent could be 10 times what my mortgage is. My mortgage is not much of anything. We pay more in food costs than my mortgage. And I did that on purpose. I locked that sucker in and I just said, I'm not paying it off. Let inflation eat this thing away. So I'm just going to ride it. At least that's my current feelings on it. I have a 2.75% mortgage. And then it was higher than that when I first purchased the home. And then I locked it in 2021, if I can remember correctly. And that's where we're going to hit it, guys. So that's what we've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website, and that's what I've got for today, guys. So we'll catch you next time. This is Finding Value.